Good evening, guys. Please confirm you can hear me.
We can, Jane.
Yes.
All right, that will be fine. All right. Thank you guys for coming through for our second lesson for economics. As I've highlighted in our last lecture, we are going to do a couple of free classes just to help each other to acclimatize to each other. Just give me a second. So today I won't be showing my face because we have got a little bit of load shedding on my side. But however, now I'm sure most of you have seen my face from the other videos, and you will see my face in the next videos. Just that I've got load shedding today, so I won't be able to show my face. All right, so let's see where we can start. All right. So I'll go straight into the study module, and then we can discuss a little bit afterwards about the nitty-gritties that you might want to know in case this is your first lecture, right? So we met, I believe some of you, I met you last week on Sunday, and some of you, I met you yesterday. And we introduced the topic of what economics is all about. So we defined economics as the study of human behavior, or as the study of the choices that people make because of scarcity. And we highlighted the differences that exist between macroeconomics and microeconomics. And then we talked about the different definitions of the different terms that we will see when we are discussing economics, where we talked about scarcity, wants, opportunity cost, and economic goods. Then we went into a detailed analysis of what the economic problem is and the three questions which are tied to economics, which are what to produce, how to produce, and for whom to produce. And then lastly, we ended our discussion by highlighting the three major economies, which is the command system, the market system, and the mixed system. We are highlighted that the mixed system is the system that is mainly used in South Africa, right? So in these questions, at certain points in time, I was highlighting to you guys the main questions that you might see when you get into an exam situation, right? So one of the key questions that you can see in an exam situation is your ability to identify if a specific economic issue or economic situation or a scenario belongs to macro or microeconomics. And to answer this question, I recommended you guys to have a look at this specific table plus what we discussed, right? And then I also highlighted that another typical question is also to do with to do with the difference between positive economics and normative economics, where usually you are going to see, you're also going to be given a scenario where you can tell whether something is under positive or under negative, under normative, right? Then another typical question is understanding the actual economic problem, right? What is the economic problem, right? Or the different questions of the economic problem, understanding them, that when we're talking about what to produce, what are we talking about? How to produce, what are we talking about? For whom to produce, what are we talking about, right? So just take note of those specific issues from our last lecture. Now, today we want to proceed on to our next topic, right? So our next topic is going to be the production possibility curve, or the PPF, right? For some of you, this is going to be in your study guide. For some of you, it might not be in your study guide. But these are notes that are in your recommended textbook, and it's something that you will see in an exam situation. They usually have questions on the production possibility curve, or the production possibility frontier. Usually, it is abbreviated PPC or PPF. Now, when you're studying economics, right, you are going to see we are going to use a lot of graphs. We are going to use a lot of calculations when you're studying economics. That's something to be given in economics. There will be graphs, there will be calculations. These calculations and these graphs we'll be explaining certain concepts. So you will notice that the concepts that we've studied so far in economics, they can be illustrated using a graph. They can be illustrated using a graph, and that's what we want to do. So the graph that illustrates what we've been talking about so far is called the production possibility frontier. That's the graph that illustrates what we are talking about so far. Okay, I see someone is saying no sound here. I think it's on their side. Are you guys hearing me? Or it's just on their side only?
We can hear you.
Oh, okay, so I think it's on their side. All right, so I'll continue. Okay, where was I? Okay, so for us to create a production possibility frontier, we have to make assumptions. So in economics, you will notice that we will make a lot of assumptions when we're dealing with economics. The reason is that the economy is very, very complex, right? So for you to understand it from a complexity point of view, it's going to be difficult. So the easiest way is to assume or to remove the complexities and make it easier. So for example, for us to understand what we're talking about, we are going to assume a country that does not do international trade, that does not import or export. We call that a closed economy. We are going to assume a country that can produce only two products, right? We are saying that everything else they do not produce, they only produce two products. That's the assumption that we are going to make. So this will make it easier for us to talk about what we want to talk about, right? So the two products that our country is producing, we are going to say they produce computers and they produce textbooks. That's the two products that our country is producing. Now, I want you to think of this scenario very, very carefully, right? Follow me through. So remember, we said that we've got four resources, right? We've got land, we've got labor, we've got entrepreneurial skills, and we've got capital, right? Those are the four resources that we have. So if we use all of the land and all of the entrepreneurial skills and all of the capital and all of the labor, we can see that this economy produces 70 million textbooks. They produce 70 million textbooks, right? So that's one thing that they've produced using all of the resources that they have. But in any economy, you don't want to produce one product. You want to produce different types of products. So you will notice that they have a choice. It's either they can produce textbooks or computers, right? So let's say that they decide to produce computers. If they produce only computers, they are going to produce 9 million computers and 0 textbooks if they use all of the resources, right? But if they use a combination and they say, look, instead of producing only textbooks or instead of producing only computers, why don't we what? Why don't we mix it up? So this is where now the production possibility curve comes in now. That's what it tries to represent. So it then shows us that if they choose to produce 69 million textbooks, they can also produce 1 million computers. If they choose to produce 60 million textbooks, they can also produce 4 million computers, right? They are combining their resources in different in different ways, right? So in essence, we are saying the production possibility curve shows us the different combinations, right? It shows us the different combinations of the products that an economy can produce if it utilizes all of its resources, right? So the production possibility curve shows us the combination of the different products that can be produced if we utilize all of our resources. That's a typical exam question, the definition of the production possibility curve. Okay. Right. So usually it's represented not as a table, although there may be tables in your exam, but usually it can be represented through a graph. So you can see it's the same information that we're talking about. We still have got computers and we still have got what? We still have got textbooks, right? We still have computers and we still have textbooks. And what we're talking about has not changed. If we have got 9 computers, we've got 0 textbooks, right? If we've got 9 million computers, if we've got 70 million textbooks, we've got 0 computers. And then all of the different combinations, they've just been plotted onto what? Onto a graph, all of the different combinations of what we can produce. So the production possibility curve or the production possibility frontier is definitely this line over here, this blue line over here. This is what we call the PPC or the PPF, the production possibility curve. It represents the maximum combination of the different goods or services that we can produce given the resources that we have within the economy, right? Right. So now, why do we need to draw the production possibility curve? What does it show us? So other than the definition of what the production possibility curve is, because remember, we said that in an economy, there is scarcity, right? So if we utilize all of our scarce resources, right, to produce either computers or textbooks, we come up with a production possibility curve, which shows us the maximum that we can produce. But it shows us, remember, different combinations, which means that if I go on this graph and put point A and put point B, it means that as an economy or as an economic agent or as a household or as a business, I have a choice that I can make. I can either produce combination A or I can produce combination B, right? Or I can even produce combination C. So I have a choice of which combination that I make. So in economics, we then say, whenever you are looking at the PPC or whenever you're looking at the PPF, any point that is along the PPF, i.e. that is on the exact line, anything that is on the exact line, it represents that if you can change between the different things, it represents choice. You can make a choice. You can make a choice between point A and you can make a choice between point B and etc. Right? So you are allowed to make a choice in an economy. So movement along, if I move from point A to point B, I am making a choice. If I move from point A to point B, right? But you might ask me, James, if I have the ability to make a choice, what if I choose an item that is beyond the PPC? Or what if I choose an item that is inside the PPC? That can also be a choice that you can make. But these choices can be regarded as efficient or inefficient, right? Depending on what you have chosen. And we are going to discuss about that, right? So before we go there, on issues of efficiency and efficiency, let's talk a little bit about opportunity cost. All right. So I highlighted in our last lecture that opportunity cost can actually be calculated. So in a scenario where you're given a graph like this, right? And you're given points A, B, and C, right? And then you are asked, what is the opportunity cost of moving from point A to point number B? You can be asked that question by the what? By the examiner. What is the opportunity cost of moving from point A to point B? So you can then say at point number A, right, I had 10 cameras, right, and 8 mobile phones at point number A. Then at point number B, right, I now had 20 cameras and what? And 7 mobile phones. Which means that for me to gain the cameras, because remember, I moved from 10 cameras to 20 cameras. So for me to gain 10 cameras, the cost, what did I have to lose? What did I have to forego? I had to forego 1 mobile phone here from 8 to 7. I had to forgo one mobile phone. So that's how you calculate the opportunity cost. You're looking at what did I have to forgo when I made a particular choice. Sometimes you have to divide, sometimes you have to whatnot, and etc. We'll do that when we do examples together next week, right? But I just wanted to show you how you can make a decision in terms of opportunity cost. So if you are moving, let's say from B to C, right? You made a choice. You were producing at point B and you go to point C, and someone has to ask you, what is the opportunity cost? So at point B, I had 20 cameras and 7 mobile phones, right? At point C, I have 30 cameras and 3 mobile phones. So which means that for me to be able to gain 10 cameras from B to C, right, which is 10 cameras, it cost me, or I had to forgo the difference between the mobile phones, which is 4. I had to forgo 4 mobile phones, which means that the opportunity cost for 10 cameras is 4 mobile phones. If then your lecturer asks you what is the opportunity cost of 1 camera, then you can do your mathematics, your algebra, and you can divide and get the opportunity cost for what? For 1 camera, right? So we'll do a lot of examples. I think next week we are going to dedicate a lecture just to do examples, right? So that's in terms of opportunity cost, right? Through the PPC, right? I'm showing you how you can show opportunity cost and how you can calculate opportunity cost using the PPC. My next point is issues of efficiency, right? So because we said that the production possibility curve shows the maximum combination of goods or services that you can produce given the resources of an economy, it therefore means that if you are producing along or on the PPC, i.e. point B, A, B, C, we say that you are efficient as an economy. We say that you are what? You are efficient as an economy, as long as you are producing on the what? On the PPC. But what if you produce a combination D, or maybe a combination E over here, or maybe a combination F over here? You are no longer producing on the line, on the PPC, right? So because you are no longer producing on the line, anytime you produce inside the PPC, we call that inefficient. We say that this economy is inefficient because it is not producing on the PPC. Another term that we use is we say this economy is not employing all of its resources. There is unemployment, right? There is unemployment. So if a question comes in an exam, this is a typical exam question, and says, is South Africa producing on the PPC or inside the PPC? You are going to answer and say South Africa is producing inside the PPC. Why? Because we have got a 36% unemployment rate in South Africa. So because our unemployment rate shows that there are people that are not working, they are unemployed, we are therefore producing on the PPC. There are some resources, labor, which is not being utilized. So you only produce inside the PPC if there is a resource that you are not using, if there is some land that you are not using, if there is some labor that you are not using, if there is some capital that you are not using, then you are inefficient. You find yourself at point number B. But if you are using 100% of all of your resources, then you find yourself at A, B, or C on the PPC, right? Then someone might ask, James, what if the lecturer gives me something like this and say this is point Z or this is point V there, over there? What about that one? This point is what we call an unattainable point. You don't have enough resources for you to produce point Z or a point V because they are outside of the PPC. So anything that is outside of the PPC line, we call it unattainable. It cannot be obtained. It cannot be produced if it is outside of the what? Of the PPC curve. All right. So just to summarize what we're talking about, I've got a little something here, right? So point D and point E, these are what? Inefficient, because they are within, they're inside the curve. So anything inside the curve, it's inefficient. Point A, B, and C, these are efficient because they are on the PPC. We are using all of our resources, right? Point F, we said it's not yet attainable or unattainable, or we cannot produce at point F because it is outside the PPC. If we move from point B to point A, we said that is a choice that we have made. And whenever we make a choice, we face opportunity cost. Right. So I believe that's the summary of what we've just talked about. Now I want to move to my next, so there are some notes there, I'll send them to you that you can also just read through. Right. I want to move to my next point, which is the PPC itself. It does not remain the same. Remember, we said the PPC or the PPF represents the maximum product, the maximum combination of goods that you can produce within an economy, right? So it does not remain the same. It can increase or it can decrease, right? If it shifts to the right, it has increased. If it shifts to the left, it has decreased. So the only reason the PPC shifts to the right, or the only reason the PPC increases, is because of economic growth, right? Or improvement in technology, right? So when we're saying economic growth, we are saying that there is an increase, for example, in the land in South Africa. If you discover new islands, right, in the coast of Cape Town or in the coast of Durban, if you discover new islands, you've discovered new lands, the PPC will shift to the right, right? If there is an increase in the number of people in South Africa, increase in the population, right, we shift the PPC to the right, right? There is an increase in the PPC, right? If there is an increase in a capital, economic capital produced in South Africa, or an increase in the number of entrepreneurs in South Africa, again, it shifts to the what? To the right. So any increase in resources will result in the PPC shifting to the right. Then secondly, improvements in technology. Improvement in technology, because an improvement in technology means that you can manufacture or you can produce more products using the same amount of resources. Therefore, an improvement in technology will result in an increase in the PPC. Right. Then somebody might ask, James, you have just talked about the increase in the PPC. What about the decrease in the PPC? Is there anything that can result in the decrease of the PPC? Yes, there can be a decrease of the PPC, right? So number one, any reduction in the resources, if you reduce the resources of the country. So for example, let's say that we go to war, right? We go to war with Botswana, and then after the war is over, we are defeated, and then they take some of our land. This will reduce the PPC because we've lost part of our land. Or let's say that there is emigration, right? South Africans are going to the UK to work in the UK, right? They are shifting and moving to the UK. That emigration means we are losing labor as South Africans. So when we lose the labor, there is going to be a decline in the PPC. It's going to shift to the what? To the left. So emigration, loss of land, loss of natural resources, maybe because of climate change or something like that. All of those things can lead to what? To a reduction in our PPC. So that's one of the reasons you can highlight in terms of reduction of the PPC. Okay, next point. So, okay. So when you're looking at the PPC, right? Just give me a second here. I said that it can increase. So this is my PPC here. I said that it can increase by going to the left, right? Or it can decrease by going to the, by going to the right, or it can decrease by going to the left, right? It can change, right? So if the whole curve, if the whole graph changes, we call that a shift of the PPC. If the whole graph changes, we call that a shift of the PPC. But sometimes the whole graph does not change. Sometimes it changes on only one side. If you see that a PPC graph is changed on only one side, this is because there has been a change in resource utilization technologies. We are saying that the improvement in the technology that has happened in that economy is specifically aligned to only one product. It does not benefit all of the products in that specific in that specific country, but it is only benefiting only one product. So that will result in what we call a swivel. A swivel of the PPC, right? A movement on only one side of the PPC, right? So that's what it means. Okay, I'm gonna come to your question, don't worry. I just want to see if we're done with the PPC here. Wonderful. So we are done with the production possibility curve. I'm gonna go into my next topic, but let's take some questions on the production possibility curve. So PPC, the person who's asking what is PPC, that's the production possibility curve, or what is known as the production possibility frontier. Production possibility curve or production possibility frontier. Are there any questions on this part before we move on to our next part? Are there any questions on production?
Hi, James.
Yes.
Hi, James. Can you hear me?
Yes, I can hear you.
Oh, okay. I wanted to ask, what informs the amount?
Sorry?
What informs the number we are producing?
Okay, you are breaking up, my friend. I think you can send a chat message maybe, because I can't barely hear what you're saying. Can you maybe try chat maybe? Okay,
James,
someone says here. Okay, hello?
is it production possibility frontier? What can you please spell that?
Production possibility curve or a production possibility frontier.
Okay, thank you.
Production possibility curve like this, curve, or a frontier like this. Production possibility curve or a production possibility frontier.
Hi, James. Can you touch on the swivel once more?
Okay, on the swivel. All right, it's fine. I'll come back to you. On the swivel, someone says, I just want to see if there's anything else here. Someone says, okay, all right. So when you are looking at your production possibility curve, you are given the numbers. You don't guess them from your head. They are given to you, to the person who was asking about the issue of the what? The issue of the X and Y values. They are given to you. Then someone says touch on opportunity cost again, it's fine. Someone says, yeah, does it only apply to technology or just using technology as an example? It applies mainly to technology. All right, it's fine. Let's talk about it. All right, so I'm just gonna, like 5 minutes just to revise what we've done, right? So we introduced the topic and said we want to talk about PPC. And we said that the PPC is a summary of what we were learning in our first lecture, right? It shows us scarcity, it shows us choices, it shows us opportunity cost, it shows us resources, right? So, and we said that for you to know the PPC, you have to make an assumption. The assumptions that you make is the country is producing only two things. And I said computers and textbooks. This is an example. Remember, this is just an example, computers and textbooks. So if you use all of your resources to produce textbooks, you get 70 textbooks. If you use all of your resources to produce computers, you produce 9 computers. That's what we say. And then you can plot it on a graph. You are usually not asked to plot the PPC, right? You are usually not asked to plot the PPC, right? That's not something that might ask you to do. But what they might give you, they will give you the graph, right? And then when they give you the graph, they will ask you certain questions about the graph that you're looking at. They'll ask you, how do I show choices made on the graph? How do I show opportunity cost on the graph? How do I show efficiency or inefficiency on the graph? How do I show, or what does the graph actually represent? So the first question, what does the graph represent? We say that it represents the maximum combination of the products that can be produced given what? All of the resources have been used. So the PPC, if anything, the PPC means that we are saying because of scarcity, we cannot produce anything outside of the PPC. You see this area that I've highlighted in red. This is what we said is unattainable, right? So that's scarcity. Scarcity is represented by the area outside the PPC. Scarcity is represented by the area outside the PPC. And we say that the PPC itself, you can move on the PPC. You can come here and say A, here and say B, here and say C, here and say D. Any one of these things, you can choose them. So that's choice that people make. Remember, wants, needs, demand, and whatnot. That's the choices that people can make. And whenever you make a choice, if you were at A and you make a choice of B, there is going to be an opportunity cost. I will show you the calculation again, but there is going to be an opportunity cost because you have chosen something and you have to forego something. And we say that anything that you produce on this PPC represents efficiency. Anything that you produce there represents efficiency. But if you produce inside the PPC, this is inefficient. This is no longer efficient. This is inefficient or unemployment. Because you are not using all of your resources, it becomes what? It becomes unemployment. And then finally, we said that you can calculate opportunity cost using the what? Using the PPC, right? So we can do an example here, right? Where we said here, if you were producing, let's say here you start at producing at point B, and you say, I started at point B, now I'm going to go to point A, right? You started at point B. So at point B, you had 20 cameras, right? And 7 mobile phones. And then you go to point A, that's the choice that you have made. So at point A, you have got 10 cameras and 8 mobile phones. So how many mobile phones did you gain? If I may ask the group, how many mobile phones did you gain? It's a question to you guys. How many mobile phones did you gain? One mobile phone, right?
One.
Yes. And how many cameras did you lose?
10.
10. Yes. So we can therefore conclude that the opportunity cost of gaining one mobile phone is 10 cameras when we moved from point B to point A. That's a calculation of opportunity cost. So for you to gain one mobile phone moving from point B to point A, the opportunity cost if you have to lose 10 cameras, that's the opportunity cost that you have that you have calculated. I hope now everyone is answered now. I can move on to the next subject, to the next section. Are we all good?
Yes, thank you.
All right. Then the last one, I think someone asked about the swivel and said, can you explain again the swivel, right? Okay. So on the swivel, we said here that the PPC or PPF, right, can shift. It can shift to the right or it can shift to the left. If it shifts to the right, that's an increase in the PPC, and it's because of two things. Either there is an increase in the resources or there is an increase in technology, either one of those two things. Increase in resources or increase in technology. Remember what resources are, we have 4 resources, right? Or if it shifts to the left, we said that is a decrease of the PPC, which is as a result of a decrease in resources, and I gave you examples. But I said that sometimes it does not shift the whole thing. It only shifts on one side. If it shifts on one side, we don't call it a shift of the PPC or a change of the PPC. We call it a swivel, right? We call it a what? A swivel. Because it has shifted on only one side. And swivels are because of changes in resource utilization technologies, i.e. you have got a technology that is only used in one particular product and it changes. So for example, if there is an improvement in the technology for cameras, therefore you might see that there might be an increase in cell phones, but apples are not affected by cameras, so they are not going to change at the end of the day. So if technologies for only one specific product change and don't affect other products, you might see a swivel in the PPC instead of a complete change in the what? In the PPC. So I believe I've covered that, right? So now I want to move on to my next topic, which is going to be the circular flow of income. I'm not sure if we'll be able to finish this today, but we'll try to cover as much as we can, because next week I wanted us to do revision. All right, the circular flow of income, right, in an economy, right? So within an operating economy, in economics, right, there are different people that function or that work within an economy. When I say people, I'm using a generic term, right? Number one, there are what we call households. A household is either one person making decisions or a family or a group of people that make the same decision. Right? So in your house, for example, you make the decision to buy Albany bread. Right? In a house, you make the decision to buy Albany bread. You make the decision as a family. So your demand is a family-based demand, and that's called a household. Or maybe you are single and you stay alone. It's still the same thing, right? You are all considered under household. Whether you are single or you're in a family setup, whatever it is, you're still considered under households. So households are players in the economy. Households are important in an economy because of two things. Households are the owners of the factors of production. I want that to be very, very clear. In a market economy or in a mixed economy, households are the owners of the factors of production. Right? Remember, there is someone who owns land. There is someone who owns labor. There is someone who owns capital and entrepreneurial skills. These things are owned by the households of an economy. It is the households who are the owners of land. They might not use the land, but they are the owners of the land, which means that they will rent the land out to businesses. They will rent the land out to governments and etc., but they are the owners of the land, right? The next one is businesses. That's the second major player. Businesses are the ones that produce within an economy. They produce goods and services. They are the ones that have got the factories that produce goods and services, right? So these businesses are driven by what we call the profit motive. They want to make a profit as a business. Now, there is a relationship that exists between households and businesses. Households are the owners of the factors of production, right? But businesses are the consumers of the factors of production. Businesses go and take land from the households. Businesses go and take labor from the households. Businesses go and take capital from the household. So they consume factor. That's a typical exam question. That's why you see me emphasizing it. They consume factors of production. Businesses consume factors of production in order for them to manufacture goods and services. Once they've manufactured goods and services, guess what? The households are then the ones that consume the goods and services. So households consume goods and services, whereas businesses consume factors of production. So those are two things. The next thing is the government, right? The government exists in an economy to provide the economic environment in which the other players can operate. In providing that economic environment, they are going to come with taxes, they're going to come with laws, they're going to come with a legal framework or a political environment which can cause problems or which can correct problems within an economy. Then lastly, you've got the foreign sector. The foreign sector is the international, the other countries that exist within an economy. Okay? Okay, let's see, I'm just checking if there are any pertinent questions. All right, I don't see.
Sorry, can I ask you to repeat the point against foreign sectors?
Foreign sector. Foreign sector, this is the international sector. We are looking at the other countries. So for example, South Africa trades, it exports and imports goods and services. So it trades with the United States. It trades with the UK. It trades with Botswana, with Zimbabwe, with Mozambique. So that's the international sector. When you introduce other countries into the mix, these countries also produce their own goods and services, which they sell to South Africa, while South Africa produces its own goods and services, which it sells to these countries. These countries have their own factors of production, which they give to South Africa, and South Africa has its own factors of production, which it gives to these other what? To these other countries, right? So now there is a relationship that exists because of these four major players. And this relationship creates what we call the major flows of an economy. And there are three major flows in an economy. There is the production flow, the spending flow, and the income flow. Right? So when I say the production flow, what am I saying? I'm saying that there are certain goods and services that have to be produced, right? There are certain goods and services that have to be produced. So when these goods and services are produced, they flow, they move from the companies or from the businesses that produce them to their households. So that is the production flow, right? Then when something has been produced, right, the things that produce need an income. So for example, if you are a company and you use land to produce, right? You have a factory, that's a resource that you're using, right? So that factory that you have used to produce, you have to pay rentals for that factory. You have to pay rentals for the land that you have used in production. So the rent that you pay is called an income, right? So production creates incomes. Right. So another example, when you are producing, you are going to use labor. You're going to use employees within your factory. These employees need salaries, right? These employees need what? They need salaries. So if employees need salaries, what do they get? That's an income that they are getting. So each factor that is used in the production flow creates an income, right? So if I use land, I create rent, right? If I use labor, I create wages, right? If I use capital, I create interest. Then if I use entrepreneurial skills, I create profit. So these sectors of production are used here on the production to create goods and services. But once they've created goods and services, we need to pay the owners of the factors of production. And when we pay them, we give them an income through rent, wages, interest, and profit. And when we give them this income, guess what they do? They spend this money that we've given them. They spend it. And what do they spend it? On the goods and services that we produced. So you can see that everything is interlinked. The production is linked to the incomes. The incomes are linked to the spending, and the spending is linked to the production of an economy. Okay. So now that you know the major flaws of an economy, now we want to talk about the different markets that exist in an economy, right? So there are two types of markets that you can see in an economy. There's what we call a factor market, and you will see these things, they will come back together at once. I'm just teaching you the silos, but at the end, we'll combine everything together, right? So there are two markets that you see in an economy. There's a factor market and there's a goods and services market. When I say goods and services market, I'm saying the market where you buy your tomatoes, the market where you buy your cucumbers, the market where you buy your bread, the market where you buy your vehicles, the market where you get your house. That's the goods and services market. So in the goods and services market, it is the companies that are the suppliers. This is an exam question. Please pay attention, right? Goods and services market, the companies are the suppliers in the goods and services because they are the ones that manufacture. And then the households are the consumers of the goods and services market because they go to the market to consume. And the households in this particular market, sorry, just give me a second. And the households, what are they doing? They are spending the income that they were given within this particular market. Now, when you go to the factor market or the resource market, this is the market where you buy as a company labor. This is the market where you get properties to rent for your company. This is the market where you get entrepreneurs. This is the market where you get the capital you need to start your business, right? So the resource market, it is the households that are now the suppliers. Please pay attention to that fact. It is the households that then supply the factor market. And it is the companies or the firms that are now the consumers in the what? In the factor market, right? I hope that is very, very clear because that's a typical exam question there. It's almost in every exam. All right. So now we want to combine everything together that we've just talked about. Right? We want to combine everything together. Right? So our first assumption, we are going to have a simple economy. Remember, I said we're going to use a lot of assumptions. Closed economy, I told you what closed economy means. It means that we don't have international trade in a closed economy. We don't have international trade. Then I'm also going to assume that we don't have a government. So I'm assuming that we don't have international trade. I'm also assuming that we don't have a government. Right? So if we don't have a government and we don't have international trade, how do things interact in economics? Right? So remember, we said that there are firms. Firms represent companies. And then there are households in an economy. Right? And then we said that there is a market for goods and services. And then there is a market for factors of production. So this is what happens in an economy. Let's go through the red line. I want you to look at the red line first. Right? The red line represents the production flow. Remember, I said there are three flows. The red line represents the production flow. So the households provide the what? The factors of production to the factor market. And the factor market then goes to the firms, and the firms produce goods and services and provide them to the market for goods and services. And these goods and services then go to the households. That's the production flow, right? Households provide factors of production. They provide land, labor, capital, and entrepreneurial skills. These factors of production are consumed by the companies, and the companies produce goods and services. The goods and services which are now in the market for goods and services are then going to the households who consume the goods and services, and that's the production flow. The production flow goes in the opposite direction of what are called financial flows, right? Of what are called financial flows. And what are financial flows? Financial flows is the spending flow and the income flow. Remember, I said there are three types of flows: production, spending, and income. So both spending and income, we call them financial flows, and they go in the opposite direction of the production flow. I'm emphasizing this because it's an exam question, right? So let's go in the opposite direction, right? So the companies, when they get factors of production, they take an income and put it into this market. Remember, we said this income represents what? Rentals. It represents wages and salaries, interest, profits, right? So this income is given to the households. Because remember, the households are the what? Are the owners of the factors of production. So they're the ones that get rent. They're the ones that get wages. They're the ones that get profit. They're the ones that get interest, right? And when these households get interest, guess what? In the opposite direction of production, they take that income and spend it in the what? In the market for goods and services. And when they spend it in the market for goods and services, this money ends up back at the what? At the companies, right? So you can see that the red line represents the production flow, and it goes in the opposite direction of the green line, which represents the financial flows, which is made up of the what? Of the spending and the income flow. Okay? Let's make it more complicated, right? Remember, I said this is closed economy, no government. What if I introduce the government? What if we say that our country has got a government, just like we have in South Africa? We've got a government, right? Yes. So now introduce the government. We still have got the companies, we still have got the households, but now we've got the government. The same thing still happens. We still have households, we still have companies, sorry, that produce goods and services, right? They produce goods and services. And these goods and services are purchased by the what? By the households. So the companies produce goods and services. That's production. And the people spend their money on these goods and services. That's spending. Right? The households still supply the companies with factors of production. That's production. But the companies also still supply the household with an income for the factors of production, which is wages, interest, whatever. Right? So the flows are still there. Those three flows, they still exist in this diagram. But the only difference now is because we've introduced the government, we've got some extra activities that happen with the government. So for example, the government will charge the companies with tax. So there is money that is moving from the companies to the government, which is a tax, income tax, or a VAT tax, whatever it is. And then the government, when it gets this money, guess what? The government also needs textbooks. The government also needs computers. The government also needs food. So the government will go to the companies and buy certain products from the companies. So there is a relationship between the government and the companies. The government also has got a relationship with the households, right? The government is going to ask the households to pay taxes. We all pay income tax, huh? So we are all paying taxes because of the government. And then when the government gets taxes, guess what it does? It issues some grants to the underprivileged within the community, and that's social transfers. So there's money from the government to the households, and the households also pay taxes. But guess what? The government also needs labor. The government also needs land. The government also needs capital. And guess who is the owner of land, labor, and capital? It is the households. So the government is also going to take land, labor, capital, whatnot from the households. And they have to pay also wages, interest, profits, and rentals, and etc. Right? For those factors of production. So we have now introduced the what? The government. Let's make it even more complicated. So we still have got our businesses. We still have got a government. We still have got our households. But now we've got a foreign sector. Remember, we said there are what? There were four role players: the government, the households, the companies, and the foreign sector. Now we've introduced the foreign sector. So everything still stands. We still have got a resource market. We still have got a product market. Businesses go and take their labor, their capital, whatnot, from the resource market, and they pay income, rentals, and whatnot to their households. Households still supply to the factor market, right? The same resources, right? Businesses still go to the product market and supply goods and services, right? These goods and services are still consumed by the households. And when the households consume, they spend, and that spending goes back to the what? To the businesses. The government is still related. They still have got taxes that they charge business people, and they still buy goods and services. The government also still has got a relationship with the households. But in addition to all of this, now we have got a foreign sector. And guess what? The foreign sector is going to the product market. The people in the USA or in the UK, they like our beef in South Africa, right? So they are going to come to our product market to buy our beef. And when they do that, there is money that is going to flow into South Africa in the form of foreign exchange. And there's beef that is going to flow out of South Africa in the form of exports and whatnot. So there's going to be some exports and some imports that are going to happen between the product market and the foreign sector. But also, the people in the UK, they like our chartered accountants in South Africa. So they're going to come and hire chartered accountants from the resource market in South Africa. So which means that there is going to be some wages that are going to be paid by the foreign sector to South Africans. And also, as a South Africans, we're going to employ some foreigners. So there are some wages that we're also going to pay from our resource market to the foreign sector, right? But here is the interesting thing. We had one market here and two markets here. Now we are going to create a third market, which is the foreign exchange market, because of the foreign sector. There is a fourth market, which is called the financial market, that we are also going to introduce. So in addition to the resource market and the product market, when we introduce the foreign sector, we now have got a foreign exchange market where we exchange our rands for US dollars. And then finally, we can also have a what? We can also have a financial market, right? Where we have our what? Where we've got our money, where we keep our money as a what? As an economy, right? So the last thing that we're going to talk about today, we still have time. Okay, we're actually out of time, but yeah, just bear with me. Let's talk about the last thing so that we know that this topic is covered, right? Leakages and injections. Leakages and injections. So remember what I said, some of my notes, I'm taking them from the textbook. You might not see it in your study guide, but I'm taking it from the textbook because I've looked at your past exam papers. I just want to make sure that everything that I've seen in your past exam paper, we cover it, right? So within our secular flow of income, okay, the reason why we call it secular, right, is because production goes to income, goes to spending, goes back to production. Everything is equal to each other. Production, when you do economics 1B, you will notice that we were going to actually do equations. Production is always going to be equal to income. It's always going to be equal to what? To spending. It's secular. It flows around. There is nothing that is going to be lost. But unfortunately, in the real world, there is something that is going to be lost in the real world. So this is what we want to talk about. What can leak outside of our secular flow of income and what can be injected outside of our secular flow of income, right? So in terms of leakages, these are the leakages, right? So if a government comes into a secular flow of income and they ask you to pay taxes, right? So remember, production is produced maybe 100 million. Income has been given for 100 million. Right? But when you go to spend, the government takes 20% in terms of taxes, which means you can only spend 8 million. So this means that there is no longer equality between income and spending because some of it has been taxed, right? So that's what we are saying. So there has been a what? A leakage outside of the system because of a tax. The same thing also with imports. If we produce 100 million in an economy, right? But 20 million is delivered to the USA instead of South Africa, which means that there is no longer equality between production and income in South Africa, or production and spending in South Africa. Why? Because part of the product have not been delivered to South Africa, right? Or savings. If you get an income and you don't spend all of your income, you get 100 million in income and you choose to save 50 million, it means that you are not spending it. So therefore, you are going to have a leakage out of the system. So taxes, imports, and savings are leakages of our circular flow of income. But also there may be injections, things that can add to our circular flow of income. So transfer payments, these are grants. Transfer payments are just grants, right? So if the government gives money to someone who is not working, right, it means that that person did not produce anything, but they are getting an income. So our income will be more than our production. So that's an injection, right? Because it's no longer circular, that's an injection. Or if we export, there is money that is going to flow through the economy. That's going to be what? That's going to be an injection in the economy. Or if there is an investment, let's say that if Microsoft comes in and invests 33 billion rand into the South African economy, that's a what? That's an injection. So transfer payments, exports, and FDI are injections. Whereas taxes, imports, and savings are what? Are withdrawals or leakages out of our circular flow of income. So ladies and gentlemen, this brings me to an end of these topics that we're covering. The next topic that we would want to cover will be demand and supply. But before we do that, next week when we meet, I'll take questions, don't worry. Next week when we meet, we want to do practice questions. So I'm going to send you guys these notes, right? They have got practice questions at the end. The last slide here, practice questions, right? Please attempt these questions so that you can see if you were learning from what we're doing. So you can see here, you need to, what is the opportunity cost? Next one here, can you fill in the details? Next one here, and etc. Please attempt these practice questions in your spare time. And then when we meet next week, we do them together. Your formative assessment number one, your first assignment, formative assessment number one, it will be these questions that we're going to practice together. These will be the questions that you will see in your formative assessment number one. So please make an effort. Please make an effort to what to practice some of these questions that I am going to send to you guys. Please make an effort. I'm going to send them to the group. It's going to be a separate slide that we have got the questions. It's going to be a separate slide that we have got the questions only, the questions only. Please practice them. If you have any difficulties, when we meet next week on Sunday, we do them together as a class so that you can see if you have captured the material of what we were learning over the last two classes. Right? Then once we are done with that, then we can move to demand and supply. We can move to demand and supply. So for microeconomics, on Sunday next week, I will make an exception and make it a free class. On Sunday next week, I'll make an exception and make it a free class since it's revision for the stuff that we're doing together. So I'll make it an exception and make it a free class for next week, Sunday. But that's just an exception. Remember, like I said, we are now going into paid classes, right? For those students that are willing to proceed with the paid classes. I've sent through my details in the group. I will resend them again after this class. I'll also send the notes that we did today in the class. I'll send the recording that we did today in the class, and I'll send the homework that I've highlighted in the WhatsApp group. If you do not get this material, please, you can WhatsApp me. You can just WhatsApp me. I'm sure you've got my number. You can just WhatsApp me if you don't get the material in the group. Maybe you will be in the wrong group or something. Right? Are there any questions on what we covered today before we dismiss each other?
Yeah, James, I asked a question just around the swivel. Would we get any questions that's related to the changes that happen in the swivel?
In the what?
In the swivel.
Okay, in the swivel, yes, what the lecturer usually does is he can give you a scenario. He can tell you that there is a that's good. He can tell you that there is a country that is producing two products, right? There's a country that is producing two products. Maybe they are producing mangoes and they are producing maybe computers, right? And then he will tell you that there's been an improvement in the technology for producing computers. How is this going to affect the PPC? So you know that because it's only affecting computers, this is not a shift of the PPC to the right. Rather, there's going to be a what? A swivel of the PPC. Or alternatively, he can give you different graphs and show and tell you to which of these graphs represents the scenario that he has given you. So if you go through the questions that I'm going to send you as homework, you will actually see some of these questions that will show you how the questions will come like. So please make an effort to go through the homework because it helps you to actually see how the questions that you're going to get look like so that you can see whether you are prepared or you are not prepared. So you can do your little homework, you write your answers down, and then next week when we meet together, you can mark yourself. And if you mark yourself and you get 10 out of 10, then you know that you are good to go. If you mark yourself and you get 4 out of 10, then you know you need to do more reading. You need to watch more videos, you need to attend more lectures, and etc. I hope you answered. Let's see. Another question here. Someone says, hi, James, do we need to buy the textbook? Or we are okay with the study book alone? Okay, so this question depends. So for the students that will be attending my classes, I usually tell them don't buy the textbook because I will be your textbook. Because my notes, I prepare my notes using the textbook. I don't just use your study guide, I prepare the notes using the textbook. So for the students that are joining my classes, you do not need to buy the textbook. But if you are not joining my classes and you do not have a background in economics, I would recommend maybe you should buy the textbook because it will help. There are certain topics where your lecturer does not go into detail, where you would definitely need the textbook. So if you are not joining my classes and you don't have a background in economics, please buy the textbook. But if you are joining my classes, don't worry, I will be your textbook. Okay, next question here. Let's see. Someone says here, can you please share your number and the microeconomics WhatsApp link? Okay, I will do that. You can just wait. I'll do that as soon as we are done with the lecture. I'll share it on the chat there. Let me just attend to the other questions before I do that. In terms of my number, it's very straightforward. It's 071 3000 634. That's my number there. Right. Then another student says here, let's see. Okay, yes, the recording will be shared in the lecture, in the WhatsApp group. Someone says, is there a possibility that the macroeconomics classes can be done on a Wednesday evening? Unfortunately, no, there is no possibility for that. The standard will be every Sunday evening for micro. I've already sent out the timetable. Wednesday evening, there is a different lecture on Wednesday evening, and I myself, I will not be available on Wednesday evenings. So the standard will be the lectures will be done every Sunday for microeconomics, every Sunday at 7. Okay. Someone says here, I think those are the main questions. I don't see any other question there. Is there any other question? Hello?
James,
Yes.
can you hear me?
Yes, I can hear you.
Can you hear me?
Yes, I can hear you.
I just want to ask, yes, okay. I just want to know if you're still going to offer at least one more free class for business finance next week or?
No, business finance, we are done with the free classes. For those that are interested,
we're
I've already
done.
given you guys the details because we are going to be doing the assignment on Thursday for business finance. So that one cannot be a free class, unfortunately, because we are actually going to start working on the assignment on Thursday. For economics, we have not yet started working on the assignment, so that's fine. We can do one more free class, but for business finance, unfortunately, no.
Okay, James, another question.
Yes.
If you find that during Wednesday, I think the actual day that you are offering the classes for business, I think it's when the
For business finance is
somewhere
Thursday.
there.
For business finance is
If one that
Thursday.
at least that day it doesn't, yes, if it doesn't accommodate you, will you at least make an effort just to offer someone who has paid or not?
What we do is
Will you try to accommodate him in another?
every lesson that we do is recorded. Every lesson that we do is recorded. So the way that we usually accommodate students that cannot fit on a particular date is you can have access to the recordings. Then on top of the recordings, remember, once you have you are part of the students that I am tutoring, you also have got access to me, because you can call me at any point in time. Hi, James, I went through the lecture that you guys did yesterday. There's a particular thing that I don't understand. Can you spare 5 minutes to explain it to me? That will be fine with me, because you're part of the students that I'm what? That I am helping. But the way we accommodate students that cannot meet on a particular date is through the recordings. Every lecture that we do is recorded. I hope you answered that.
Okay, I just answered my next question, because I was gonna ask if it, I understand that you're gonna send a recording, but the recording isn't actually help you, because you when you actually have some questions, who's gonna answer those questions? You
No,
already
you
answered my
are
next
free to
question.
give me a call. As long as you're part of the students that I'm helping, you're always free to give me a call. If you don't get hold of me, you just have to be patient, because remember, there might be other students, but you are free to give me a call as long as you're part of the students that I'll be helping. Yes, someone says, do you still have got classes for informatics, analytics, and etc.? Yes, guys. Okay, just a disclaimer just before I start saying what I'm saying, but some people might get confused. There is a lot of you in this class that are not doing the same programs. Take note. There are people that are doing advanced diploma that are joining this class. There are people that are doing first year in IT, first year in HR, first year in accounting, and etc. All of you are from different what? From different degrees, right? So yes, we still have got classes. So for the guys that are doing advanced diploma, we are still going to meet, I think, on Monday for marketing, which is going to be free. And I think on Wednesday for management, which is going to be free, right? For the guys that are doing first years, this whole week, it's still going to be free. I think we've got, I don't remember the dates by head now, because there are so many of you, but we've got Introduction to Business Management, which I think is tomorrow. We've got Informatics, which I believe in project management, which I believe is on Tuesday. We've got a digital transformation. I think it's on Wednesday. We've got a lot of modules that we're going to do. I will just resend the timetable to the group. So that it's easier for everyone to just follow through from that timetable. Any other questions? Also, my number is always free, guys. You can send me a WhatsApp message. We can chat if you've got a particular question that was not addressed within the confines of this particular platform. All right. So I think the last thing is someone wanted the group. So I'm going to share the group here. Just give me a second. WhatsApp group. So I have two separate groups that I have here. I've got groups for the guys that are doing ADBM, Advanced Diploma in Business Management. That's the one that I'm going to share first. And then I've got a group for the guys that are doing first year. That's the group that I'm going to share second. So please join the one that is relevant to you. So this one that I'm sharing right now is for the guys that are doing advanced diploma. That's the one that I'm sharing right now. Okay. So this is for advanced diploma students, right? And then for the guys that are doing first year in economics, first year students, those are doing accounting, HR, supply chain and whatnot, ITM, your group, I'm sending it right now. So this is for the students that are doing fair. Please join the correct group. Don't get confused and end up in a group that is not yours, because it might end up confusing you. So the guys that are doing, where is it? that are doing first years. So this is for the first year students. So this is for the first year students, i.e. the guys that are studying BCom and a BBA. The guys that are studying the BCom, the BBA, the BPA students. Those type of students, that's your WhatsApp group there. So I think everyone is covered. I don't know if there's still any other issues before we close the lecture for tonight.
And James, I asked how much do you charge for your lessons?
Okay, for the first year students, it's 800 Rand, including both the KCQs. We will help you one-on-one with your KCQs, it's 800 Rand. Then for the guys that are doing advanced diploma, it's 750. They only have one KCQ, so it's 750 for the guys that are doing advanced diploma. I will share the details in the groups in case you get confused. I'll just reshare in your specific groups. I will reshare the prices and the, the banking details and whatnot, and the videos and whatnot. You can also just check your WhatsApp groups, or you can message me. You are free to do installments. You are free to also do installments. If you can't afford to pay the full amount, you are free to do installments. Okay. Is there anything else before I go, guys?
Is it 800 Rand per month or per module?
Per module. Per module.
Oh, for the whole period, ne?
Yeah, per module.
Thank you very much.
James, this group you are sharing now is different from the one that you were using.
Sorry?
For the
yes,
the
it's
group
different.
that
Yes.
it is different.
Unless if I'm misunderstanding you, but it's different. Because I have groups for people that have paid me. People that have joined my classes, have paid for my classes, I have separate groups for that. The ones that I'm sharing are the generic groups, because I don't know whether you guys are going to be interested or not interested. But I do have separate groups for the people that are interested in continuing with the service. Like I said, there are free classes here and there that we are doing, but once we are no longer doing free classes, we'll only be attending to the students that are interested in continuing with us. So we have separate groups for those. So if you have made a payment and have not added you to the group, please call me so that I can add you to the group. If you've made a payment and have not added you to the paid group, please call me so that I can add you to the correct group, to the paid group.
Okay.
So James, but we still do have an opportunity now to get it, because we, like for example, I've only been on the economics. You did confirm we still have free for management, so that we see the rest of the other people, because thus far I've only interacted with only you. Okay, cool. That's fine. Sharp. Thanks.
The only one that is no longer free is business finance. That's the only one that is no longer free. All the other ones are still free.
Which one is no longer free?
Business finance, for the guys doing business
finance.
finance.
Oh, business finance. Yes, I don't do business
but every
finance.
other module for this week, don't worry. Every other module for this week is still free, other than business finance.
That's fine.
Because business finance, we need to work on the assignment quickly. So that's why.
So are we going to get invite on the WhatsApp like today?
Yes. Yes, we are. We are.
Thank you very much.
All right. Sure.
Thanks, James. Bye.
Bye-bye, guys. Hope you have a wonderful evening.
Thanks, James. You're good.
Bye.
Thank you, James. Bye.
Thank you.
Thank you.